episode 50 in just a minute. I hope you had a good day. Relax. Relax. Remember, we're talking about 2019. Last time we talked about how to think about the future success of your money. I hope you enjoyed that episode. As well as previously, we talked about something very similar about persistence pays off in the future of your money. A lot of people like tapping for ASMR and page turning. It's very, very relaxing. So again, I hope all of you are relaxed and ready for episode number 50, where I'm going to show you the money as far as how my portfolio did in 2019, which, as you can imagine, based on my last two episodes, I'm sure you know that it did quite well. And just to re-emphasize what I talked about, again, I think it's so important for all of you to think about the future of your money. I can't stress that enough. I want you to be living your life right now, happy every day. Don't think about money. Set it and forget it. Do automatic contributions into your 401k if you have a 401k. Maybe also do contributions into your Roth IRA if you choose to have a Roth IRA, or maybe a traditional IRA. And just have fun. But always know in your mind that you are conscious and awake about making correct financial decisions, no matter what is happening in your life. That's what I want you to think about, that all of you have the ability to make the right choices. Now, it may be that you make mistakes like I did, as you know. I made a lot of mistakes with finances when I was younger, but I had time to recover. But I don't want you guys to make the same mistakes that I did. I want you to stop and think about the ramifications of, for example, spending a lot of money. If you're a person right now that found ASMR Money Mentor, and I'm glad you're here, by the way, but if you're spending a lot of money and you feel like you're out of control, go to my playlist and take a look at some of my other episodes from the past. Maybe look at my balances, my episodes where I talk about building a budget. I want all of you to build a budget for every single year and always know exactly where your money is. You can't make mistakes if you know where your money is. Okay, so just wanted to start this episode by having a little reminder. I mean, all of us should always be reminded about our money, and the choices that we make are generally our choices, and we have to own up to that sometimes, don't we? I mean, there will be things that happen in our lifetimes, of course, that are out of our control, but let's do our best to control, as I always say, what we can control. $606,000. Okay? And remember, I also teach everybody that you want to record your beginning balance. So for me, it was 606. And then I recorded at the end of 2019 how much money I had. And it happened to be 805,000. Now, before I go on and talk about some more details about that, I wanted to share with you that the S&P 500 in 2019 returned 28.88%. That's almost 30%. I talked about that last time. That's a huge number. So 28.88%. Just Google it, you'll see. The S&P 500 returned in 2019 that number. I also wanted to share with you that my total income for 2019 was $99,709. Of that, nearly $100,000 I saved and invested $60,000, which is nearly a savings rate of 60%. And that's if we just take the total number, right? As I've shared with you in previous episodes, you can take tax out first to get a more accurate representation of your savings rate. But either way you do it, it's roughly, 60%, which again is a good number and something that you should always try to attain, is to save a little bit more every year. Now, the one thing I want to share with you is I like to reverse engineer at the end of the year and cross-check. Those are my two favorite phrases. Reverse engineer and cross-check. So if you go to a compound savings calculator at dinkytown.net, and if you put in the starting amount of $606,000 with 1 year to save, and if you put in a rate of return of 20%, as I mentioned, because that's what I got, and by the way, I'm backing into this. I didn't know it was 20% until I back into it. Does that make sense? Because I put in the ending balance of $805,000. That's what I'm trying to solve for as you reverse engineer. Does that make sense? So in the calculator, I can put different percents in until I get to as close to $805,000 as possible, knowing that I also put in $60,000. So you add that into the calculation as well. That's under a line item called additional contributions. Because let me just pause for a minute. That $60,000 includes what I put into my 401k and the matches. Do you remember when I did my build-a-budget? My build-a-budget before. Remember, you take your total income and I add to my total income matches. I want to know what that dollar amount is, because then I subtract it out and put it into the appropriate savings bucket, if that makes sense. So that $60,000 again includes what I put into my 401k, what I put into my Roth IRA plus the match, what I put into my taxable account and into my savings accounts. Now, we know that savings accounts weren't making as much as the stock market, obviously, but we're just looking for an average of what our portfolio did based on what we know happened with the S&P 500, because I was balanced. I wasn't in all stocks. Now, I also want to say, for multiple years, I would look at my budget for the year and I would get to December and I would be like, Evan, you did great, pat yourself on the back. You stayed within your budget for fun money. You stayed within your budget for everything else. And then whatever was left over that I had allocated as a line item for savings and investing, I would look at that number at the end of December and say, okay, this is what I'm going to pump into my taxable account in a lump sum into a low because I wasn't sure how the year would pan out. I would wait till the end of the year, and then I would take that number, let's say it's 5,000 or 6,000, and I would just invest it all in one lump sum into that taxable account, which again was in an index fund. Believe it or not, I was watching a YouTube channel recently, and somebody said that lots of young people, so that might include you, and don't feel bad if this is what you think, because remember, when I was your age, actually I was 40, I didn't know what a CD was, a certificate of deposit. So let's put that into perspective. But it resonated with me because what this person said is that a lot of times young people don't realize that the vehicle is your 401k or the taxable account or a Roth IRA. It just is a vehicle in which you put the money into that your engine is then comprised of. I know that's kind of a weird analogy, but work with me here. But then you decide as a savvy investor what you're going to put that money into, and that's where you can get the help from a financial advisor if you need to, or pick maybe a low-cost index fund that rides the market of the S&P 500, because I always say it's better to put your money in there than to not do it and not take action because you don't know what to put your money into. Just choose a low-cost S&P 500 or total stock market type index fund, and because it has lots of stocks in it, that would be just fine, especially when you're younger, and it's more important, as I said, to put your money somewhere than to not do it at all. But that resonated with me because I thought, wow, some people, just like myself when I didn't know what a CD was, may not know that the umbrella is the vehicle, and then you have to choose what to put your money into. And she actually said that some people were putting their money into a Roth IRA, into a money market fund, which really doesn't make sense, does it? Because a money market fund is a cash account. You might as well just have that in a regular old money market rather than putting it into a money market within the vehicle of the Roth IRA. Okay, so getting back to the calculator that I was sharing with you and how you can reverse engineer into your numbers, that's how I then determined that my portfolio for 2019 returned 20%. Because remember, I took those numbers and it gets to about 800,000. It's really close. I was at 805, but if you put in 20%, you get to 800,000 after you contribute 60,000 beginning, remember, with 606 to 805. Now, as I think about closing today's episode and to wrap this up, I also wanted to share with you that this is how I would like you to think, and it does anchor to my episode of this week as well, in thinking about the success of your money. While you are young and while you are doing this, again, we don't care if the market goes up or goes down. Why? Because you're not selling your shares. So don't worry about market fluctuations. But when you get to the point where I am, because I want to retire in a little while, right? You start thinking a little differently. You start thinking about how people say to you, you know what, you can take about 4% off of your money. You should be fine. Don't worry about it. Well, I'm going to give you an example of how fine you can really be by looking at the numbers of 2019 in which I just shared with you. So let's do a little role play. Let's pretend as though I retired in 2019, which I was about to do, by the way. And so I would have looked at that year and I would have been like, wow, the market did really well. I got 20%. Now, granted, I wouldn't have been putting 60,000 in, but just work with me here. money I put in. But look at that number. So for this year, and not all years will be this good, but $140,000 is what I like to refer to as other. Do you remember what other was? Other is things like on bonds, it could be interest. In your stocks, it could be dividends. And real quick, if I haven't mentioned this already, dividends are what mutual funds pay on a quarterly basis, regardless if the stocks go up or down. Some people think you could take those dividends if you're retired and put them in your checking account, but Vanguard has been teaching me that they prefer a total return approach, and they like to reinvest those dividends rather than paying them out to their customers that are retired. Made sense to me. But $140,000 includes potential interest, dividends, and what was the other thing? Unrealized gains in this particular case. Now, if I was retired in 2019, I would have been like, yes, let's definitely pull our money to live the $50,000 need that I have. Let's just say it's 50. Well, if you take 140 minus 50, you still have $90,000 that is in your engine. Make sense? So you just now paid yourself in this example, and these are rough numbers, by the way, not including taxes, etc. But it was a very positive year. So if I took away that 50 grand, I still had 90,000 left over that got reinvested into the engine. That's the way I wanted to think about the success of my retirement, in that I was keeping the principle intact, if that makes sense. So I hope that motivates you in terms of watching your money grow while you're younger. And maybe the why of what you're doing that we talk about all the time is that you can eventually get to a number where your investments pay you to live your life. And again, if your expenses are super low, then you now have a lot of wiggle room. Maybe you didn't need all 50. So maybe you don't take all of that out, you just take a little bit. But these are things that I remember